Imagine for a moment that an entire country's economy was supported by a single company that refuses to open its books. Sounds absurd? Welcome to the world of cryptocurrency, where Tether Limited, a company based in the British Virgin Islands, controls over $100 billion in assets that serve as the backbone of the entire crypto market. Tether issues USDT, a stablecoin that should be worth exactly $1. It's simple in theory. For every USDT created, the company should have $1 real stored somewhere. But here's the problem that keeps analysts awake at night. Nobody can verify if this is actually true. Behind the scenes of the crypto market, USDT has become the blood that feeds the veins of the system. When you buy Bitcoin on Binance, sell Ethereum on Coinbase, or trade any altcoin, there's a huge chance you're using USDT as an intermediary. It's the currency that connects everything, the bridge between the traditional and digital worlds. But what if that bridge is made of toothpicks? What if we discover that the $100 billion supposedly backing each USDT doesn't exist? What would happen to your Bitcoin investments? To the entire market? The money trail we're following today reveals one of the biggest financial question marks of our era. A company that moves more money than many central banks, but operates in the shadows, far from the eyes of regulators and independent auditors. This is the investigation into Tether's black box, and what we found might shake your beliefs about the future of cryptocurrency. To understand how we reached this giant question mark, we need to go back to the beginning of the story. Tether was born in 2014 with a simple and powerful promise: create a cryptocurrency that had the stability of the US dollar, but the agility of blockchain technology. The idea was brilliant. Crypto traders needed a fast way to exit volatile positions without having to convert everything back to real dollars, a slow and expensive process. USDT would be the solution, a digital currency backed one-to-one with physical dollars. In the early years, everything seemed to work perfectly. Tether grew meteorically. From a few million USDT in circulation, it jumped to billions. Today, there are over 100 billion tokens in circulation, each supposedly guaranteed by $1 real. But it was precisely in this explosive growth that the first cracks in the facade appeared. In 2017, hackers stole 31 million USDT from Tether. The company simply burned these tokens, removing them from circulation. But the question that lingered was, if they had real dollars to guarantee these tokens, where were those dollars? The architecture of the operation also raised eyebrows. Tether Limited was registered in the British Virgin Islands, a tax haven known for opacity. Its executives were the same as Bitfinex, one of the world's largest cryptocurrency exchanges. And even stranger, Tether never provided a complete audit of its reserves. What the evidence began to show was a concerning pattern. Every time the Bitcoin market crashed, new USDT were created out of thin air. Coincidence? Many analysts began to suspect not. The veil of opacity surrounding Tether isn't accidental. It's a deliberate strategy that has frustrated investigators, regulators, and investors for almost a decade. Let's zoom in on this systematic resistance to transparency. In 2017, when the first serious doubts about Tether's reserves emerged, the company hired Friedman LLP, a respected auditing firm, to verify its assets. But just 3 months later, the partnership was mysteriously terminated. Friedman never released the complete results of their investigation, but the truth was much more complex than these documents suggested. In 2019, during a legal battle with the New York Attorney General, Tether was forced to admit something shocking. Only 74% of USDT in circulation were backed by real dollars. The rest was invested in other assets. Let's zoom out to understand what this means. If you have 100 USDT in your wallet, believing they're worth $100, in reality, only $74 actually existed. The other 26 were in investments that could be worth more, less, or even nothing. The company's black box revealed even more disturbing secrets. Court documents showed that Tether had lent $700 million to Bitfinex, its sister company, to cover undisclosed losses. It was like discovering that the bank holding your money was secretly lending your deposits to a casino. The battles with regulators reveal a pattern that should make any investor lose sleep. Tether isn't just opaque by accident. It has a documented history of lying about its reserves to financial authorities. In October 2021, the U.S. Commodity Futures Trading Commission imposed a $41 million fine on Tether. The reason? The company had lied about having 100% of its reserves in U.S. dollars between 2016 and 2018. During this period, Tether publicly guaranteed that each USDT was always backed one-to-one with traditional U.S. dollars. It was a lie. But the point of no return came with the New York Attorney General's investigation. For 2 years, Letitia James and her team dug deep into Tether and Bitfinex operations. What they found was a silent bleeding in the company's coffers. Bitfinex had lost $850 million of client funds through its payment processor, Crypto Capital Corp. To hide this catastrophic loss, Bitfinex secretly borrowed $700 million from Tether's reserves. It was like robbing Peter to pay Paul, but on a scale that could break entire markets. The final settlement cost $18.5 million in fines for Tether. But more important than the money were the forced admissions. The company had to publicly acknowledge that its reserves included loans to affiliates, investments in commercial paper, and other assets that weren't U.S. dollars. The money trail showed something even more concerning. Documents revealed that only a small fraction of Tether's reserves was actually in cash. The rest was spread across risky investments, including loans to Chinese companies and corporate debt securities. They had transformed what should be a safe vault into a speculative investment fund. Let's zoom out to see the real dimension of this time bomb. USDT represents more than 60% of all cryptocurrency trading volume worldwide. It's the fuel that powers the crypto market machine. When you buy Bitcoin, Ethereum, or any other cryptocurrency, there's a huge probability you're using USDT as an intermediary. The architecture of dependence is frightening. Exchanges like Binance, Huobi, and dozens of other smaller platforms depend on USDT to provide liquidity. If Tether collapsed tomorrow, these exchanges would have to suspend trading or face a digital bank run. But the domino effect would be much broader. Bitcoin, which many consider a digital store of value, is intimately connected to USDT. Academic studies show a suspicious correlation between the creation of new USDT and increases in Bitcoin's price. If this correlation is causal, if new USDT are artificially inflating Bitcoin's price, then we're looking at a bubble of historic proportions. To understand the magnitude of the risk, imagine we discovered tomorrow that Tether only possesses 50% of the reserves it claims to have. $50 billion would simply evaporate from the crypto market overnight. Bitcoin's price could plummet 70 or 80%. Smaller exchanges would go bankrupt. Millions of investors would lose their savings. The clock is ticking, and each day that passes without complete transparency from Tether increases the systemic risk for the entire market. The truth about Tether remains buried in its black box, but the evidence we've gathered paints a deeply disturbing picture. We're facing a company that controls over $100 billion, influences the price of trillions in crypto assets, but operates with the transparency of a criminal organization. The facts are undeniable. Tether repeatedly lied about its reserves, was fined by regulators, admitted in court that it doesn't possess 100% backing in dollars and continues to refuse providing a complete audit of its assets. Any traditional bank operating this way would be shut down immediately. But the question that remains is deeper than Tether itself. What does this tell us about the maturity of the crypto market? How did an industry that prides itself on being decentralized and transparent allow a single opaque company to control its financial infrastructure? The answer is uncomfortable. The crypto market chose convenience over security, growth over sustainability. Tether offered instant global liquidity, and the market closed its eyes to the systemic risks this created. The future of Tether, and by extension, the entire crypto market, depends on a simple choice: transparency or collapse. There's no middle ground when you're dealing with $100 billion of other people's money. If you own cryptocurrency, if you trade on exchanges, if you believe in the future of blockchain technology, you have a direct interest in this story. Because until Tether completely opens its books, the entire crypto market remains built on a foundation that might be made of sand. Tether's black box isn't just a financial mystery, it's a stress test for an entire industry that claims to be revolutionizing the global financial system. The corporate world is hiding trillion-dollar secrets, and we're just getting started. If this video opened your eyes, smash that like button and share it with anyone who owns crypto. They need to know what's really backing their investments. In the world of corporate power, knowledge is protection. Stay informed, stay skeptical, and we'll see you in the next Dark Suits investigation.